Welcome back to the 1 Minute Trader podcast. I am your host, Matt Davio, and I'd like to continue talking about the trading process. We've been talking about this in the previous couple podcasts. In the first podcast, I talked a little bit about how I trade. I emphasized the importance of understanding the market's context, whether current action is situated within strengthening, weakening, or bracketing stable conditions. The second podcast, I stressed the importance of identifying key price levels as potential price targets for trade ideas. The concept that unites these two ideas for me, however, as a short-term trader, is day structure. Each day has a particular structure that is really important to it via price action and strength and weakness. Identifying the likely structure for the day as early as possible is perhaps the most important skill demanded of the intraday trader. And intraday trading is but a piece of my trading, but I do want to talk about it, and that's why we've done this brief 3-part series here for the podcast. I say this because you can be very skilled at recognizing chart patterns or reading immediate supply and demand in the order book, which are different skill sets. But if you get the day structure wrong, you can easily find yourself selling in a market that is ready to break out to the upside, or buying at the wrong time in a waterfall situation where the markets are falling. So what does day structure mean for me as an intraday trader? As an intraday trader, day structure is trumps longer time frame trend considerations. What do I mean by this? It really means that although the longer term time frames are important, what is happening in the day, in the moment, is going to trump even that overall longer term trend. So if you look at the markets and you see that we're selling the S&P 500 in the morning, and all the contextual indicators said that we were in a rising market, you would see that we're saying this because maybe the overnight high was likely to move back towards the prior day's pivot level. In other words, I was identifying a potential range day early in the session and keying my trade off that information from yesterday. So in my preparation, I think about 7 day structure possibilities. Number 1, a range day. This is pretty basic. The market will oscillate and bounce between I call it also a ping pong day. Bounce between an average price value with relatively low volatility throughout the day, likely ending in a day not far from its opening price level, or its volume weighted, or exponential moving average, or point of control, right? These are all kind of the same terms for similar things. Number 2, an upside trend day. This is, again, the market will open near its low for the day session and build its way higher through the day, closing at or near the highest prices. The market will tend to stay above its moving average, its exponential moving average, or VWAP, most of the day. And really what's important here is the point of control really isn't that important for the day. We may be moving to another point of control, which is in play, but just the fact that we're in a trend day, up or down, really doesn't mean much when it comes to the point of control often. So the third type of day we mentioned already is a downside trade day, and this is simply when the market is opening near its high price of the day for the session and working its way lower throughout the day, closing near or at the low price, and the market tends in this situation to stay below its exponential moving average or volume weighted average price. Number 4 type of day in intraday day trading is the upside breakout day. The market will open within a range, say 30 minutes or 60 minutes, but will build volume and attract participation at the upper end of that range, leading to a price break above that range and further acceptance of that price above the range with solid volume. The thing about an upside breakout day that is great is usually when it breaks out, it does come back and test. So I often like to buy just a little bit on the breakout and maybe sell a little bit as it runs, and then as it pulls back, buy a little bit more. So an upside breakout represents the transitioning from a range or a bracketing day to an upside trending day. Now, the reverse of this is the downside breakout day, and it's again the same thing. The market will open within a range, but will build volume and attract participation at the lower end of this range. And when this happens, we break the price, and we again tend to test that more often than not. We'll test that breakout just to see if it's real. That's a good spot to enter, and we'll continue on. A downside breakout represents a transitioning from, again, a range-bound market to a downside trending conditions. Now, why do I say use those testing areas as areas? Because there are false upside breakout days and there's false downside, and those are our 6th and 7th types of markets here. The market opens within a range and moves above the range, usually within limited participation. This is a false, and so the volume wanes at these higher prices. So this is where you really need to pay attention to the context and the minutia of what's going on in the market. If we fail, that represents that false breakout represents an extension of the day trading range, and we'll continue back into that range. The 7th, again, a false downside breakout day. The market opens within a range, moves below the range with limited participation again. This is key. And the volume wanes at the lower prices, and we break down and we bounce back and come back into the range. So in closing, why are these important structures for day traders, intraday traders? In range markets and on false breakouts, you'll be trading for moves toward the volume weighted or point of control, and often the prior day's pivot area. In trending and breakout markets, you'll be trading for moves away from the VWAP toward R1, 2, 3, and the support. So resistance and support become very important. So in other words, you'll be fading price strength and weaknesses in range and false breakout days, and in trending days, you'll be riding the trend. Without proper understanding of these market contexts and key price levels, it is very difficult to get a handle on day structure early in the session. You'll find yourself looking at very short-term setups only to miss the more basic question of whether we are moving toward or away from the most estimates of our value or our point of control. That's not to say that trading very short-term setups can't be successful. Rather, you want to put yourself into situations where you can really gain the most out of a day trade context situation. So these are key to a trader's understanding and success if you're going to day trade, that you must understand these various types of days. And we thank you again for watching and listening to our podcast. I am Matt Davia with the 1 Minute Trader podcast. And please like us on iTunes, Stitcher, SoundCloud, and Spotify. And please tell your friends as always. And if you have questions, just drop me a note, Matt@OneMinuteTrader.TV. And thanks again for listening, and we'll talk to you on the other side.